Hello everyone, welcome to Millennaires channel. I hope you are investing for the better future. Today we will look at tips or steps to avoid common investment mistakes. Let's start with the tips or steps. First one is trading too much and too often. When investing for the long term, patience is the most important factor. Often it takes time, for example, 5 to 10 years, to gain the ultimate benefits of an investment and asset allocation strategy. Continued modification or changes in investment tactics and portfolio composition not only reduce returns through greater transaction fees, it can also result in taking unanticipated and uncompensated risk. You should always be sure you are in track. Use the impulse to reconfigure your investment portfolio as a prompt to learn more about the assets you hold instead of as pushes to trade. Next is not having clear investment goals. There is a saying, if you don't know where you are going, you will probably end up somewhere else. Is as true of investing as anything else. Everything from the investment plan to the strategies used, the portfolio design, and even the individual securities can be configured with your life objectives in mind. Many investors focus on the latest investment fad, for example, bitcoins, or on maximizing short term investment returns, instead of designing an investment portfolio that has a high probability of achieving their long term investment objectives. Next is expecting too much or using or depend on someone else's expectations. Investing for the long term involves creating a well diversified portfolio designed to provide you the appropriate level of risk and return under a variety of market scenarios. But even after designing the right portfolio, no one can predict or control what returns the market will actually provide. It is important not to expect too much and to be very careful when figuring out what to expect. Nobody can tell you what a reasonable rate of return is without having an understanding of you, your goals, and your current asset allocation. Before we move on, don't forget to subscribe our channel for more learning on investing. Next tip is buying high and selling low. The fundamental principle of investing is to buy low and sell high. So, why do so many investors do the opposite? Instead of rational decision making, many investment decisions are motivated by fear or greed. In many cases, investors buy high in an attempt to maximize short term returns instead of trying to achieve long term investment goals. A focus on near term returns leads to investing in the latest investment craze, for example, bitcoins or fate, or investing in the assets or investment strategies that were effective in the near term past. Either way, once an investment has become popular and gained in public's attention, it becomes more difficult to have an edge in determining its fair value. Next is reacting to the media, that is, mainstream media and social media. There are plenty of 24-hour news channels and also many social media influencers that make money by showing tradable information. It would be foolish to try to keep up. The key is to pass valuable information out of all the noise. Successful and seasoned investors, for example FII and DII, gather information from several independent sources and conduct their own proprietary research and analysis. Using the news as a sole source of investment analysis is a common investor mistake because by the time the information has become public, it has already been factored into market pricing. Next, and the next one is letting emotions get in your way. Most investing brings up significant emotional issues that can hinder decision making. For example, do you want to involve your spouse in planning your finances? What do you want to happen when with your assets after you die? Don't let the immensity of these above questions get in your way. A good financial or investment advisor will be able to help you construct a plan or portfolio that works no matter what the answers to these above questions are. And the last tip is try to time the market. Market timing is possible, but it is extremely hard, even for the seasoned investor, for example, FIA and DIA. For people who are not well trained, for example, retail investor, trying to make a well-timed call can be their undoing, a very big mistake. An investor that was out of the market during the top trading days of Nifty index from 1993 to 2013 would have achieved a 5.4 annualized return instead of 9.2 by just stay invested. This difference suggests that investors are better off contributing consistently to the investment portfolio rather than trying to time the market by getting into trade in and out in an attempt to time the market. So, these are some of the tips to avoid investment mistakes. I hope this video must have given you some clarity about the common investment mistake. Do send us any queries or doubts in the section below. See you soon with another detailed video on different aspect of investing. Happy investing and thank you for watching.